Live. Okay. Hi, good afternoon. This is Prashant Mehta here. Welcome to the webinar on REITs, specifically on the Embassy REIT IPO. Over the next few minutes, we will cover REIT in general, and we'll also cover the key features of the IPO. Now, REIT. What's REIT? Real Estate Investment Trust. Real Estate Investment Trust is fully regulated and well-structured product. This trust is like a mutual fund which pools investors' money into real estate and deploys it in a very structured and a professional manner. So that, in short, is what a REIT or Real Estate Investment Trust is all about. REIT regulations were recently formed by SEBI in 2017, and Embassy REIT IPO is the first IPO to be launched in this space. Now, before we proceed on the details, we will give you our overall recommendation and then we'll proceed into the details of the IPO. Now, the recommendation is this is suitable for those investors who have lower risk appetite and who also desire asset class diversification in real estate. Particularly, the deployment of this money is into premium grade A commercial real estate through a well-structured mechanism. The second point is the returns. Expected returns in this IPO for the investor comprises of two parts. Part A is the yield on the property which they buy and give it on rent. So that's called rental yield. The expected annualized rental yield for their portfolio is between 7.5% to 8.5% per annum. So this is the part A of the return on the portfolio. The part B of the return on the portfolio is the capital appreciation within the portfolio. Now, historically in India, the space that they are in, which is called grade A commercial property. Grade A commercial property basically means that these are very high premium office spaces. So to just give you an example, in Bombay, for those of you who are in Bombay itself, let's take an example. Express Towers in Nariman Point is considered a grade A commercial property. So these are examples of grade A property. So Embassy REIT IPO invests in grade A properties and gives it on rent. So one is the yield, which is 7.50 to 8.50% per annum. That is the yield. This yield is an expected yield. It is not a guaranteed yield. The expectation is based on the net cash flows available from the projects. The second part is the capital appreciation from these projects. It is expected. Again, this is not a figure which is confirmed either by the company. It is expected that over the last few years basis the trend. The next few years trend shows that the capital appreciation rate in grade A properties, commercial properties in India is somewhere in the range of 3% to 7% per annum as per the industry reports. So if you add the two totals, two yields, one is the rental yield and the other is a capital appreciation yield. So even if we take 7.5% as the rental yield as a conservative estimate, and we add the bare minimum capital appreciation of at least 3 to 4% per annum, we come to a figure of about 10.5 to 11.5% per annum at a conservative level. This particular figure can form the total returns to the investor who will invest in this IPO. But as I said, and I would like to qualify that this figure is not guaranteed and not assured. Now, so this is the expected returns on this particular REIT IPO. Now the time horizon. This is suitable for investors who have at least minimum 3 to 5 years. The reason for 3 to 5 years is that for the property to generate a substantial regular flow of rental income as well as the possibility of capital appreciation, a 3 year cycle is required. Because usually the projects that they also invest have a minimum 3 year cycle on an average. So therefore, the recommended time frame for investors in this IPO is about 3 years and ideally around 5 years. The next is the liquidity. Now, this IPO is listed as we all know. So therefore, the liquidity is subject to the liquidity available at the stock in the stock exchanges, both the NSE and BSE. Given that the REIT IPOs have no past track record in India, and this being the first IPO, we have to wait and watch as to what will be the liquidity of this IPO post listing. However, from your point of view and from your client's point of view, you may assume at a conservative level that the liquidity could be low. Since liquidity is a question mark because this is the first time IPO of any REIT. So given these suitability factors, this IPO can be marketed to clients of yours basis these suitability factors. Now, the next point we will go about the main features of the company itself as well as the IPO, the project itself. Now, I'll start with the company, Embassy. Embassy Office Parks is a joint venture between Bangalore-based property developer, Embassy Group, and the world's largest real estate-based private equity firm by the name Blackstone. Both of them have come together and formed this joint venture. The total holdings is approximately 33 million square feet of commercial office space, comprising of 7 large business parks and 4 city-centric buildings, which are spread across Bombay, Bangalore, Pune, and Noida. And these buildings and commercial properties are at most premium locations in each of these cities. For example, I gave you the example earlier of Express Towers in Nariman Point, which we all know is a premium location. Now, the total size of the IPO is 4,750 crores. Now we'll come to the qualitative factors, post which I will then talk about the risk factors also. Now, what are the key qualitative factors which makes this IPO worthwhile to look at from an investment point of view? Embassy Group itself is a leading high-quality office portfolio provider in India, which has best-in-class office properties. In fact, its portfolio is one of the India's largest office portfolios, and it's not very easy to replicate such a platform by other developers. Second point is that the location of these buildings and these commercial spaces are in the top performing markets. So again, that is a high barrier of entry, which means that other competitive players might find it difficult to enter into similar space. The third key feature is that the rating. Now, they have gone for a rating for this IPO since it is the requirement from SEBI, and they've gone through ICRA. ICRA is Indian Credit Rating Agency. ICRA has assigned a AAA rating to this REIT, which means that REIT has the highest degree of safety in terms of financial obligations. Now, further on, as we move on, few more key points. The property, which is the Grade A commercial buildings, which is owned by Embassy, is currently occupied by a diversified and high quality multinational client base. So, for example, Fortune 500 companies like JP Morgan, Google, Microsoft are some of the key companies which have occupied space in those buildings. The model is that these companies sign a long-term legally rental escalation with the Embassy Group. And Embassy Group is therefore assured more or less of a continuous and a regular source of rental income. As of 31st March 2018, approximately 81.4% of the gross rentals were from the 160 marquee, which means leading companies that they have contracted with, and most of them are multinationals. So they have a very high quality tenant base, and the rentals are all long-term contracted. The weighted average lease period is 6.9 years, which is considerably long and which provides reasonable stability to the portfolio. The business model itself is dependent on various factors. The biggest factor is a net cash flow. So cash flows will come from the rental income plus the possibility of capital appreciation from some of the properties which they may sell at some point in time. The other positive point about this IPO is the quality of management. When one looks at the call, and which is again a driving factor, the management is extremely experienced, with CEO itself having a long and a very good track record in this space. The sponsors, as I said earlier, Embassy Group and Blackstone are renowned sponsors. In fact, Blackstone is the world's largest private equity firm in this space. So the sponsors are also having deep and global expertise. While Blackstone brings global expertise, Embassy brings in local knowledge to this entire venture. In terms of, and one of the good important points to note in any commercial grade A property related business is that what is the occupancy, which means how much percentage of your property is actually occupied and how much is vacant. Currently, as per the offer document which they have filed with SEBI, portfolio is stabilized at 95.0% committed occupancy, which means 95.0% of their properties are occupied and have long-term commitments, which is a very good positive factor. Being in the premium locations, the market rents of their properties, as per their own estimate, is about 34.5% above the normal rents. In terms of the last few years' financial performance, particularly if one looks at fiscal year 2016 to fiscal year 2018, the revenue from their operations have grown by 15.4% in fiscal year 16 onwards up to fiscal year 18. So they have shown a reasonable amount of revenue growth from operations over the last 3 years. The other important point to note is what is the debt, which means how much leverage or how much borrowings has this company made. After utilization of this IPO money, the total debt is expected to be little less than 15% of the market value of their properties. So that gives an idea about the leverage of this entire REIT business. The REIT business, the way it is structured is through a SPV, which is special purpose vehicle, which is structured in a way that the money flows, the money of investors, which your clients will invest eventually in this IPO, will go through the SPV and be invested by REIT, which is Embassy. SPV is standing for special purpose vehicle. Now, the next point. The next point is issue pricing. Now, I'm sure you would have noted that the issue pricing which you have read everywhere is a price band of rupees 299 to 300. Now, how has this been arrived at? Whatever information the company is giving us, basis that information, what we can understand is that the book value or the net asset value of their properties as of 31st December 2018 is rupees 376. They have priced the entire offer at a floor price of 0.79 times the net asset value, which is rupees 299, which is actually 0.79 times rupees 376. And that is at the floor level, and 0.8 times at the cap level. So they have priced the IPO at a price which is lower than the net asset value or the book value of the properties which they are owning. So we have covered over the last few minutes, we have covered the key highlights, the qualitative factors of the IPO. And we also now understand what is the potential for appreciation in terms of both rental income and the appreciation over capital appreciation. Before we proceed to the other point, which is very important, the key risk factors, I'll just take another minute and speak about the taxation. As an IPO investor, when your investors enter into the IPO, since we are recommending 3 years and plus, below 3 years, the taxation is such that there is a short-term capital gains tax, which is levied at 15% plus STD plus the cess. So for all investors who enter now and they exit before 3 years, the short-term capital gains tax applicable to this is 15% plus the STD and the education cess. For all those who remain for more than 3 years, the long-term capital gains tax is applicable to this, which is 10% plus STD, subject to the long-term capital gains exceeding rupees 1 lakh in the financial year, as per the current budget, which has recently been announced. So this is the taxation aspect. Now, the other aspect is, which I'm sure all of us are thinking, is that when will the investors get the income, which is the rental income, at least 7.5 to 8.5. So as per what they have given in the offer document, the declaration of NAV of the underlying properties of the entire SPV is twice a year. And the distribution of this dividend, this is through the dividend, will be done at least twice a year. So this is what one can expect as an investor. Twice a year distribution of the dividend, plus whatever the capital appreciation would happen over a period of few years. These two components will form the total return for the investors. Now it's important to understand what are the key risks. While we have understood the highlights, we have understood the recommendation that we are trying to make and the entire business model, there are a few risk factors which also need to be understood in order to give a very balanced approach to this entire discussion. Now, the risk factor is that first risk factor. Whenever they are leasing the property to various tenants, they have to sign something called as formation transaction agreements, which is very important. So they have not yet at the moment executed the formation transaction agreements, which will therefore, in case there is a delay or there is some lack of few agreements being signed, then they may have to bear some existing liabilities, which may affect the cash flow of the IPO, the REIT, rather the SPV. And this cash flow will then affect the distribution. So I'll just take a step back. Now, as per rules, 90% of the net distributable cash flows of the SPV, which is structured purpose vehicle, is to be distributed compulsorily to all the investors as per the SEBI rules. So whatever they earn as net cash, 90% of which will come back to all the investors. And they will retain only 10%. So what are the factors which will affect this particular 90%? Because this is where the returns are coming to for the investors. So we'll look at those factors which affect the distribution of this 90%. So as I said, the first factor was the execution of formation transaction agreements, which are pending. Second is, currently the units which are offered in the market are not owned by the owners as part of the sale, and they will be, and in the process, the units in the issue in exchange for equity shares held by the selling unit holders in the relevant SPVs. Those agreements, those transactions are yet to happen. Third point, and which is a little significant as well, is the amount of debt, external debt. After the completion of this issue, they intend to obtain external debt financing to repay a portion of the debt of their existing portfolio, as well as to finance the further portfolio's requirements. So basis the debt that they take, the interest cost on that debt might be a limiting factor in terms of the amount of distributions they can make to the unit holder. The other point, of course, we discussed earlier is that the guarantee of distributions. So, as per the rules of SEBI, guarantee is not there, but these are estimates. So when we communicate to our clients, I'm sure you will take enough care to communicate in this particular manner. Real estate market. Now, the business that they are in basically is commercial grade A real estate market, which we are all aware is dependent on the Indian economy as well as the financial stability of Indian markets. And we all are aware as well that real estate markets are historically cyclical. So that point also has to be borne in mind that this is a cyclical business. It has its ups and it has its downs. When the business, when in their sense, in the commercial grade A space business may have a slightly lower downturn, then at that point in time, they may have lower occupancy, which may affect the rental income. The other important point to note is the concentration of tenants, concentration of sectors, and the park and the sub-market concentration. I'll explain each separately. Now, the tenants that they have, typically about 42% of the tenants are very high-profile tenants. So the top 10 occupy approximately 40% of the revenues. Any change anywhere there might, at some point in time, affect the revenue stream. Sector concentration. A lot of these tenants are from the IT sector. So as I said earlier, Google, Microsoft. So IT sector tenants are concentrated in their portfolio. Any business dynamics change within the IT sector might at some point in time has the possibility of affecting the revenue. There was another point which is just to be noted, and that as of 31st March 2018, they have a contingent liability for some claims against these SPVs which they have not acknowledged as debt. And this is liability in respect of property tax matters, which is approximately 424.49 crores, which has not been provided for. A lot of these properties are located on government land. For example, some of these assets are located on land leased from the government of Maharashtra, agencies like MMRDA, MIDC, Noida. So there are legal and regulatory compliances that the company will have to constantly make in order to comply with all the laws. Lock-in restrictions. REITs, as per SEBI rules, have a lock-in restriction. Given these lock-in restrictions, they will be required to hold any completed and rent-generating property or under construction property for a minimum period of 3 years from the date of purchase. And that is one of the other reasons why we should be communicating to investors to have a 3 to 5 year at least horizon. Whatever they will earn as cash flow, net cash flow, 90% of that will be distributed back to all the investors. Out of their entire portfolio, approximately minimum 80% will be invested in ready projects and only balance 20 in under construction. So since some of the portfolios will have under construction projects, the time and the cost to complete those under construction projects will be a risk factor to take care of. And there have been some observations by the statutory auditors in their audit report, which is there in the offer document. So we have covered all the key risks to the entire business model that they have. We have also understood that this is a very innovative and a very new way of investing in this real estate class, particularly grade A commercial properties, and very well structured and well regulated product. We also understood the returns, the risk, the time frame, everything required for this. What is the cash flow? How much returns investors can expect. So with this, I end my session. And in case you have any queries, you can write to me. I will give you my email ID, Prashant Mehta, PRASHANT Mehta @plindia.com. Thank you very much. Good day.